All right. So here's a graph that's good to look at to know how exactly is the business making money. All right. So here's Microsoft, right? This is Microsoft as of 2022. You can see very important information. It's the biggest revenue segment in Microsoft is intelligent cloud. That makes up about 38% of its revenue. Microsoft's revenue is actually very well structured because each category almost has the same amount of size to each other. Intelligent cloud has 38%, productivity and business processes have 32%, and more personal computing has 30%. In total, they're almost the same amount of size there, right? And that's very good because Microsoft is usually the best at those majorities while also gradually improving them, right? So, for example, Microsoft is dominant when it comes to productivity and business processes and more personal computing because they're the areas that they're excelling at than anyone else. And they're the ones solving the problem more effectively than anyone else, that the customer for that niche that sticks with them. And they've been doing this for decades, right? That it makes up about 62% of their entire revenue. While on the other side, intelligent cloud, they are one of the best there, right? But they don't have a complete, distinct, better difference if you compare it to Amazon's web services or AWS, which is the same thing, or Google Cloud, right? Same is said with those companies having yet distinct, better differences than Microsoft's Azure. Okay. Also, just to let you know, the productivity and business processes inside Microsoft, that segment comprises Office 365 or Microsoft 365. Also with the Xbox, I believe. Microsoft 365 has PowerPoint, Excel, Word documents, OneNote, all the 365 apps that Microsoft owns. I mean, it dominates in that section. Google has another section that's more apart with compatibility with the search as itself. If you're trying to apply more search into your documents by having web links in a way. But in Microsoft, it's more hard data integration and faster download speeds with more compatibility with features per se, more compatibility and more accessibility towards different features that are more reliable when it comes to constructing your productive work. That's why it's called productivity of your Excel documents, your spreadsheets, your Microsoft documents in these platforms more than Google's documents, right? And then more personal computing, that's their operating system. That's Windows. Every single computer in the world that is not Apple has a Windows. That's just the way how it is because Windows has the best operating software there is, and it's the most widely used, and it's an enormous brand. So they're dominating those two areas. But in any case, looking at this specifically, looking at this graph here, you can notice a few things. A very important thing is looking what are the costs afterwards when the revenue comes in. The first immediate expense is first of all, not even. The first immediate expense to anything when you make revenue is depreciation from inflation. That's going to happen with everything. That's going to happen to your returns on investment. That's going to happen to your business sales, right? The first thing a company needs to deduct out of anything else is depreciation from the currencies that they're using. So the first immediate expense, though, is the cost of goods sold, which are the costs that was made to make the item and sell it. After this, you get gross profit. From here, it automatically pays total operating expenses, which most of the time, for many companies, you just have SG&A expenses and you have R&D expenses. SG&A stands for selling, general, and administrative expenses. Every business has an SG&A in their operating expenses, and it shows nearly all business costs that are not directly attributable to making a product or performing a service. It has all general and administrative expenses and the direct and indirect selling expenses of the business. Also, managers tend to like to target SG&A for cost reductions because they don't directly attribute to the cost of making the product or service. That's why SG&A is not in the cost of making goods. That's why it's not in the COGS column, because it doesn't attribute to actually producing the cost of or the expenses to produce the product. Rather, instead, it's the cost of the operating expenses in which it's done of the cost to operate the business rather than to manufacture or produce the product or service, which is in the cost of goods sold, right? And then R&D, on the other hand, is research and development. It's primarily used for the business to pay for enhancements, improvements, and innovation to its existing products on the market and new products that are not yet in the market. This is where the innovation and improvement is mostly done. This is great if you look at this because Microsoft has a very low COGS. Look, it comprises 31% of the revenue, and the gross profit that comes out. Let me get because I like to use it like this, right? Their operating expenses makes up about 38% of their gross profit. That's super low, right? This is great for Microsoft. They have a low cost of manufacturing and production for the products and services they make. They have a low operating cost to even run the business in total. Innovation, R&D, SG&A, all things from there, they're very low compared to the gross profit that comes out and compared to even the revenue. It's a very small amount of cost that it gives. This gives more space and room for Microsoft to do more things with their investments, improvements, along with wealth accumulation for their products and services to be better and to increase the value of them because they have more features. They're worth more. They're better products. This brings the business value up. This always gives a lot of room if Microsoft wants to do something very innovative per se. They have the existing profit already to do it in R&D without affecting it much, and where the net income at the end can still be increasing steadily per year. After operating expenses, you get operating income right over here in this column. Everything after this, after the operating income, are interest and tax expenses or incentives on the income standing. After these expenses, you get now net in total income out of necessary expenses to run the business, which is the net income. This is fantastic. If you look at the net income outstanding, it makes up 36.7% of the total revenue, which is actually the profit margin. That's the profit margin. This is a good profit margin, as Microsoft is able to keep a pretty good amount of profit that first comes in afterwards all the expenses have been deducted, showing how, and this shows how lucrative this business is to cash in easily as well as to cash in with its profits. This tends to be usually common in technology, but technology tends to have pretty low operating expenses along with pretty low cost of making the item or the product or service. That by nature, not all the time, right? It depends how lucrative their product even is in the first place, like whether it's a valuable product. But if they have a valuable product, a low amount of cost to make the product and a low amount of cost to run the core business and to making the business better from R&D nature and SG&A, the profit that'll come out is going to be a big profit margin, and they'll have a lot of net income standing out. And this gives a lot of room for this type of company to make something very innovative for evolving its products, that it won't be able to sacrifice its huge amount of revenue or a huge amount of gross profit. The R&D taken in place can go up as much as it wants, right? But the gross profit is already very high, right? Because the first thing that was deducted, remember, the first thing that's deducted when the revenue comes in is the manufacturing of the products. So the manufacturing cost or production cost of the products are very low, or the services are very low. Automatically, if the operating expenses aren't a bit low, they can increase the R&D into a significant amount, and that won't affect as much towards their net income. Maybe it might drop a bit compared to last year, but it won't drop like by 60% per se. So that's fantastic. That's really good. That tends to be common in technology. That's really good when you combine it with an actual valuable product that they have and no one else has, or service. Okay, so you might be saying, okay, where can I find this information? Well, you can find it in many areas, but these are the ones I recommend the most. Guru Focus. The data that I was showing recently for how it makes money, all the visual bars and graphs are located in this website. Now, this website is not free, though a tip that I can give is that just go in incognito mode all the time and enter the website's name and start researching what company you want to look for. And when your time is up, right, just close out of incognito mode and go back to incognito and repeat this process. You'll be able to keep researching endlessly for hours by doing this. Now, the SEC. This is the best and only way to get a full proper answer, to understand what the company has done for a certain year and to look at everything from what it's selling the most, what it's lacking, all its competition, its areas where it wants to invest, reasons why their income dropped slightly to where their cash went down or why their financing activities went up. Whatever the reason, rather than just reading a blog from somewhere else, from some person who has a biased opinion based upon the company, who knows as much as everyone else does. Look, you get a full answer by reading the filings in the SEC. You get a full answer literally why each thing has changed and improved or not from a certain specific area in their business and their statements in their filings. They have to do every once a year in their annual reports or their filings. This is where I get all the juice, and it's the only place you can actually get a full solid answer, a good answer on how like their statement improved, like why their revenue increased compared to last year to why they have more cash that went down from the last year. Look, they will explain to you every single reason and the purpose of the reason, an explanation towards why each thing's changed that makes up in total the core company. And they will show and explain the most important parts in what it's selling the most and where it's selling the most in terms of clients and in what region are they selling more geographically and by, I don't know, industry per se too. So there's no place to get an actual answer from literally getting it from the little company in it from itself and from the CEO by reading the annual reports or their filings. This is why I find it very silly for people to pay research providers when those providers can only get as much deep research from the filings as much as everyone else does. Do it yourself, and you will get such a great detailed answer and valuable insight in the company that you can't get anywhere else, in places of importance that you didn't see before, compared to a researcher who just mashes up a bunch of the data and simplifies it and doesn't provide you the deep research to actually understand the company, rather than just looking at a bunch of numbers, which is pointless, right? To understand the company truly in its roots and all around it and what it will become, you have to look at their annual reports or their filings. So to do this, you can look up in the SEC, right? The SEC is the Security Exchange Commission. They provide you these filings if you go to sec.gov. You just afterwards, when you get into the website, you will see a search bar, type the ticker symbol of a company, and you'll be able to have access towards their filings. Specifically, you only care of looking at the annual filings. So the best one, the best type of filing you want to look for is called the 10K. In their 10K, you can find all of this valuable information and much more than that from any other provider that's going to be able to tell you in this document. Just so you know too, every company is required by law and must file a report every few periods of a time per year if they are a public traded company in the US. Companies offshore aren't obligated to do a 10K that's listed in the US market, like the New York Stock Exchange. So the best way to look at a foreign company's reports is to just search on Google, for example, ASML's annual report 2022. From here, you should find it mostly from the company's website or another provider who has a PDF of the document. The great thing that I love about the annual reports or filings is that you can go anywhere in time to see how they were doing in their business in that year. This automatically removes the hassle and process of not being able to go, for example, 15 years before to find how much they were making in a certain product, because almost no providers will give you that data back in time and what it was making, unless if you've paid them a significant amount. And even if you do pay them, a lot of them are probably only going to show you max 20 or 30 years ago of data. Rather, in the filings, you can literally go back all the way towards when the company went public. Because look, this is required by law. By the time they go public, by the time a company decides to go public, they have to be transparent about their business, because there's investors involved into this. There's investors coming in and they're putting their money into this. This is one of the most valuable things that literally came out of the Great Depression, since they realized the untransparencies of these sketchy types of businesses in the mid-20s, that everyone was getting in, including banks, right? Everyone was getting into sketchy companies in the 20s from this untransparency, that even banks did it. And this shows you the amount of irrationality in the world, that you can't trust to make a decision at all in investing just because some entity does it. That does not mean that you should do it. This would have been more visible if those companies were required to give this information to all investors in public. So they won't be able to do anything purposefully untransparent in order to cover up some bad situation or a problem that they have with their products or core business operations. Every company is required by regulation to state out all the biggest problems they have and might potentially have to the SEC for all investors and potential investors who want to invest in the business, right? And they state all this out in this filings document, in their annual reports. That's why I love reading the annual reports. This is what I do every single day. I literally sit and I read for hours and hours of a company. I read everything, right? Because that's how I truly understand. I read everything. I don't read anything else. I read as much as I can that revolves around the business, right? But what gives me so much insight is reading the filing to look at the facts. And I read like 6 years of different filings from the companies, so I can see how it's built up and what they were expecting, because it gives me a very strong sense and accuracy to know what the company is, who they are, what they want to do, understand where they want to go. And if I see the enormous value there, that I'm going to make the most money here than anywhere else I can think of, that's what I'm going to invest in. That's why I call this diamond investing, because you want to test it so hard through so many protocols that by the time it's fully tested out and it's still standing, it's the toughest, most accurate type of business that's shaped like a diamond and tough like a diamond. Each part you can use effectively. I like to mix and use each information for a different reason. So for example, Guru Focus is the best when it comes to visual graph data. It gives you the most complete and appealing data for an answer. For the annual reports or 10K, this gives you the full transparency, insights, data, and full material on the statements that you can't find on any provider that isn't listed on their website, but if it impacted a key part in their statements or a relevant part for their core businesses. So this is best on AR, which is short for annual reports, or the 10K. Now for Market Watch or Wall Street Journal. When you want to view a quick, efficient, relevant number summary for the statements, these are the best to find quick number data for just the top 3 financial statements. So the top 3, you guys know, it's the income statement, the balance sheet, and the cash flow. Other good sources too that are good for analytics, statements, and metrics is Finvis, Morningstar, Simply Wall Street, and Yahoo Finance. Another good website for quick data similar to MarketWatch, but specifically for Chinese companies, is an AAAstocks.com. Now, talking about the statements, I want you to understand this. Each business that is involved in other industries or sectors are going to completely differ in terms of what to look for and mine or don't mine compared to another company that area that they didn't mine is important to them and it plays a bigger role to their type of products in the industry or sector. So for example, you can't compare a bank's statement with a technology statement like Microsoft because they both require a very different capital and structure in doing their operations or at least run their type of core business to exceed their profits or services as each company requires a different set of general capital to do things as effectively. Since their business in terms of cost to deliver their services and products are a different process compared to other companies like a tech company. It's the same as being said, like if you compare a consumer retailing, like a store, a fast food franchise, or a food franchise like McDonald's or Domino's Pizza, compared to a technology company like Google. Because food franchises require a set more capital to induce and create more resources and order resources from suppliers in which they place in machines to physical output to create the product and then to sell it to customers directly, like coffee. You have to order look for coffee. You have to order coffee beans from a supplier, while change your physical labor units frequently to make it as cost effective on each area to distribute as long with the item in trend as well, to be with the trend with that, and then to create and then repeat this process to order a new type of machine and then to sell it as effectively again to the product in trend. See, a business like this requires a bit more to spend from capital, which are capital expenditures. And a lot of the times make the company acquire more debt to leverage for these type of businesses and might have slower growth of cash flow or net income, not because it's a worse business, but because in what it's selling, it's the most efficient and reliable way it needs to go in terms of how and where they need to sell in general to the best way to exactly what they're selling. So usually all business can tend to be in a general better as long-term universal principle you can use is by looking at the revenue, net income, cash increase or bigger compared to its debt as reducing. Cash flow or free cash flow has been rising years to see if it's stably strong for the future, has been rising overall for the past 5 years. And even with this part, there's a few industries in where you have to look back more than 5 years ago or 5 years in its period if it's actually stably strong for the future, like in banks, right? In banks, you have to look not just 5 years ago, you have to look like 10 to 15 years ago because of how their core businesses is constructed based on what they're selling on the industry for in total, right? So let me summarize this because that was pretty technical. What I'm saying is that, look, you cannot compare Domino's Pizza with Google in terms of what they're going to utilize in capital, because in order to process more how they evolve with pizza per se, they have to order a different type of machine with a different type of supplier based on what location they're in, and then somewhat be fixed upon a regulation to make it as effective towards whatever the property owner wants to have, or if there's any issues with that, or just the food regulation as well. And on top of this, with the trends, you have to buy more properties and equipment for that. Having more, let's say, dealers and contractors in terms of supplies with food supplies like cheese, tomatoes, sauce. Of course, in technology, you have cost to resources, but in food items like this or in consumer retailing, you have to constantly, if you're a big consumer retailing company like a McDonald's or Domino's Pizza, you have to, if you're making a new product, you have to constantly make a deal with some other contractor to give you that sort of food item. And so where you can get the relevant machines and actually pay for the machines, and that takes months, and then make the deal with the capital leases as well, structure the property in a way that it can efficiently attract more attention, provide more marketing as well. You need more marketing to induce more buying into the product, more physical locations and where you need to put into, and just employment wages. But that's the very least. It's just those when it comes to machinery, physical changes within the property. There's a lot more capital. So you see, when there's a lot more capital being involved, what it's cost, when the capital is going down, the debt's rising, that doesn't signify that it's a bad business. It just signifies that the requirements in order to produce more, in order to incentivize more consumer behavior, more consumption, more innovation with what they're selling in a different type of product like Chipotle. Look at Chipotle. Chipotle gives a different order, a new type of order, certain types of periods with the different chicken and different steak a few times, and people still consume like crazy because it's the most efficient type of a quick food making restaurant that people can just order in a few minutes, right, and eat everything and have all these sort of quote unquote healthy items inside their meal, and they're happy. That tends to happen a lot here, but in order to make these new items, they need to get machinery and all this type of stuff, right? So it promotes them to use a more capital spending than a technology company. because a technology company can delegate very effectively because they don't have to provide a lot of these huge machineries, especially that they produce a lot of the service themselves. They're able to produce them rather using a lot of the third parties a lot because they don't have to sell physically and then maintain. And it's also maintenance. You need the maintenance, the property management. Like there's a lot more accounting there on a physical store. So look, it's like comparing a tiger with a whale. They are just completely different animals with completely different requirements for its habitat or ecosystem for it to flourish in, like, and based upon what they eat, how they breathe, how they recover, how they defend or attack in the most effective way as possible based on what they're around in their habitat. You see, this completely differs compared to a tiger to a whale, because a tiger has a completely different habitat, a different way to flourish and what it eats, a different way to breathe, a different way to recover, a different way to attack. This is the same way how businesses are. When you compare a bank to Apple, when you compare Starbucks with Salesforce, when you compare Chipotle with Adobe, like they're both completely different companies that require different capital structures, different capital needs.